afternoon. It is Wednesday, the 19th of May, and I hope this finds you well. I'm going to update you on the recently handed down federal budget, which has some great news in terms of changes to superannuation legislation that's going to benefit many of you, as well as we're looking forward to what that might transpire for financial markets and assets, as well as looking forward to the end of financial year and some preparations that will be well underway. But firstly to the budget, and really one word sums it up, it is spend, spend, spend. The government has certainly opened up the checkbook to try and secure a recovery in a post-COVID world, which we're still not out of the woods by any stretch of the means, and that is certainly being demonstrated by the very strong fiscal stimulus that is being pumped into the economy through social services, through tax breaks, and general spending on government programs, all with the objective to increase employment and drive the economy and economic growth going forward. All of this, of course, at the expense of more debt. While the debt is less than what was expected, it is going to accumulate with deficits over the years ahead. Now, I don't think at any stage that debt is ever going to be paid back. We are definitely in a situation where it's that old GFC playbook where governments are printing money to spend in terms of propping up asset prices, low interest rates, and this time round, big spending government programs. Now, I'm not adverse to government spending debt as long as it is going into productive uses. And the debt that we're taking out these days, the cost to service that is at record lows. So it doesn't hurt to spend and spend productively in an economy. And certainly the government's trying to achieve that result and secure an economic recovery after the COVID disruption. COVID is still with us, and it will be very much stop-start. It's very patchy when you look at it at different parts of the world, potentially double-dip recessions in Europe. But watch the US. The US will be performing very well as an economy as it moves out of COVID, and that will be a significant driver of economic growth, as well as what we're seeing in China, who has continually, as a country, performed very well, and is, of course, buying up our iron ore to record prices. That's something that's not going to be there forever, but certainly has been very handy to support our budget yet again in a time of crisis. So what does this mean for markets? Well, it's that old playbook again. We've got low interest rates, we've got lots of spending, we've got cheap money. It's going to be good for company dividends, it's going to be good for share prices, and we are seeing this flowing into the property market as well. So these conditions are fairly benign. But we need to be careful, because at some point, if we see inflation creeping into the economy, that's going to be the Achilles heel. And I think in the years ahead, there are going to be some fears about inflation starting to return and giving market jitters. But for now, conditions are pretty well set for asset prices in the short to medium term. So where are we now as well for superannuation? Well, some good news in the budget. The government has done away with the work test. Now, the work test prevented people from making contributions to superannuation between the ages of 65 and 74 unless they had passed a work test. That has now been removed, so it means that people in that age group can contribute up to $110,000 per year as a non-concessional contribution to super. And that's particularly handy if they've got assets or cash outside super and looking to try and contribute that into a lower tax environment, as well as for simplification in terms of how you manage your retirement savings. So a big tick in terms of doing away with that. It is still a little bit unclear as to whether they're going to allow the bring forward provisions so that you could bring forward the next 2 years of contributions into a single year and doing up to $300,000. The legislative changes are not due to come in force until the 1st of July 2022. Now, one of the other measures that the government has introduced is to extend the downsizer provisions from 65 down to age 60, and that's particularly handy because we do find that people do want to downsize their home a little bit earlier than the age of 65, and what that means as part of downsizing, without interrupting your normal contribution caps, members of a super fund will be able to contribute up to $300,000 each using the proceeds from the sale of a property that they've lived in for the last 10 years. So some two really useful measures there that's been brought in, and that gives us the ability to manage some strategies in terms of estate planning, as well as for those people who have member accounts that are close to or above the $1.6 million cap. So I will be certainly looking at particular scenarios that are relevant to you as we see these provisions become law, hopefully from the 1st of July 2022. So look, finally for today, we are getting to the end of the financial year. It's been a really crazy time so far. It's been such a busy year, and now we're getting up to crunch time. So you will be hearing from me in the coming weeks about your contributions, making sure those contributions are up to date, any particular tax deductions we should be thinking about, and managing sort of asset sales and capital gains tax. So we're well and truly set for 30 June. So a bit of a long update today, but I'm looking forward to chatting to you soon. If you do have any questions or things on your mind before the end of the financial year or your portfolio generally, I look forward to hearing from you. We are continuing to work on the investment portal, and I've got some exciting developments in store for you ahead before the end of the financial year as well. But for now, that's it, and goodbye.